Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me for the first time my friend Addison Quale with me. Addison he first got his start in finance and investment consulting from Cambridge Associates back in 2008. After discovering the importance of gold as money, he subsequently joined Peter Schiff's precious metals firm, Schiff Gold in New York, and served as senior broker there for 3 years. He has now spent the last 3 years working at Monetary Metals. That's a company which offers investors the unique value proposition of a yield on gold, paid in gold, in other words, gold interest. Monetary Metals also provides gold financing for miners as well as other businesses that work with gold. Addison holds an economics degree from Harvard University as well as an MDiv from Gordon Conwell Theological Seminary, and he lives in New Jersey with his wife and 2 children. Welcome, Addison. It's really good to have you with me.
Yeah, thanks, Jay. It's a great pleasure and honor to be on your show.
It is really great to have you with me, and I should mention that we have had your boss, the founder of Monetary Metals, Dr. Keith Weiner, with us on this show in the past, and he's introduced to us some important concepts to explain why you need to own gold. But today what I really would like to do with you, Addison, is to get down to the more practical aspects of how people can actually safely earn yield on their gold. Because, you know, for the most, one of the major excuses for not owning gold, one of the reasons that the lovers of fiat money, the lovers of fraudulent fiat money, I should say, have always tried to tell you shouldn't own gold is because it pays no interest. Well, fraudulent fiat money pays no interest right now. In fact, in some cases, makes you pay for the privilege of lending your money, which is absolutely ridiculous. But now, of course, and as Addison, we've had Alistair MacLeod has recently talked about time preference, and everybody, you know, you'd rather hold your gold today unless you can get a sufficient interest or yield on it by letting go of it for the next year or whatever the time frame is. And actually, what you're doing here, as I understand it, is you're providing people with the opportunity of getting a yield that is worthwhile, at least to some people, by leasing their gold, and rather than just letting it sit in the vault. So let's explore this idea. First of all, I'm wondering could you talk a little bit about leasing as opposed to loaning? It's my understanding that if I am a lessor, if I'm lending gold or whatever the item is, it could be money as well, it could be fiat money, I'm leasing my car, I still own the car. But when you make a loan, you're actually lending your money, you're lending it, and you are really an unsecured creditor, essentially, right? Is that the difference between leasing and lending? Because as I understand it, what you do at Monetary Metals is you lease gold out to merchants.
Yes, that's correct. There is a world of difference between leasing and loaning, especially also for the business. So I think, if you use the word rent, that almost makes it more clear. If you rent a car, you go on a trip and you rent a car from the airport, it's obvious that the car doesn't belong to you. It continues to belong to the rental company. Basically, in our offering called Gold Fixed Income, you're leasing your metal out, which essentially means you're enabling a business that works with gold to rent your metal for the year. You continue to be the owner. You continue to hold title to the metal. And the company that's leasing your metal, the benefit for them is it's not on their balance sheet. So it doesn't affect sort of their debt equity ratio. It's held off balance sheet. So there's a number of different benefits from all this, apart from higher security that it's a lease, not a loan. And in a loan also, if you lend somebody gold, they may liquidate it for cash, and you don't actually own it at the time anymore. And they may pay it back with gold in the future, but they're going to have to go out and buy it first. In a lease, when you lease someone metal, the metal doesn't cease to exist or anything. It actually just changes form and location. So maybe you start off with, coins in the vault in Delaware, and you lease to a jeweler in New York, and it's merely switching. Now instead of coins in Delaware, it's gold bracelets sitting in the Brinks Vault in New York.
All right. So I understand then that from the merchant's point of view, one of the reasons that he might want to lease gold instead of borrowing money from a bank to buy the gold is that he doesn't have to put it on his balance sheet. In other words, it reduces the leverage that he would have on his balance sheet.
Exactly. That's just one of the benefits. The other benefit is, and maybe the key benefit is, if you think about it, and it's kind of surprising that no one's thought of this beforehand, but a jeweler, for example, their revenues are based on the gold price. So it's kind of silly to think, well, and in these businesses, they need financing. So let's say they need to build out their inventory. They're going to go to the bank and they're going to get a loan for $1 million. What are they going to do with that? And take the $1 million and they're going to buy gold, gold chain. They're going to pound it into necklaces and then they're going to sell it. Well, what if they go out, they borrow $1 million to buy, say, 700 ounces of gold, and by the time they have those gold chains come to market a month later, the gold price isn't $1,500 anymore. It's now $1,200. Mm-hmm. So they're in trouble. Now they're insolvent because the product they're about to sell is worth less than the loan.
Yeah.
So they have to hedge. They have to go and hedge the gold price, which means that instead of borrowing from the bank at 5%, they're borrowing from the bank at 5%, plus they now have to hedge. So now add another 1 or 2%. So it's really more like 7%. Mm-hmm. What we do at Monetary Metals is we say, hey, instead of having your financing and your revenues apples to oranges and you have to hedge, why not just have it apples to apples? If your revenues are in gold, why don't you borrow in gold? Mm-hmm. And then you don't have to worry about a fluctuating gold price. So that's one of the added benefits. That's why companies want to lease your metal.
All right. Very good. Well, what kind of businesses, real quickly here, Addison, what kind of businesses are interested? Jewelers, that kind of thing? What kind of businesses are really interested in doing this then? I guess they're businesses that actually use gold.
Yes. These are product. Yeah. So this offering is called Gold Fixed Income, and it's lease focused. So these are businesses that have a physical inventory of metal. So that could be a bullion dealer, a jeweler. It could even be a metals recycler, mints, mining companies. It's actually surprising. We have a gold manufacturer. They make, paper thin, sort of gold dollar bills.
Mm-hmm. It's like I've seen them. Yes. Yeah. Okay.
So yeah.
So how much gold do investors need to get involved with this? Because as I understand it, Monetary Metals will package a deal, and then they'll have maybe, 10, 20, 30, or maybe more investors that send their metal to Monetary Metals, and Monetary Metals then makes one lease to a jeweler, let's say, for example. How much gold do people need to own? They can send their coins, their maple leafs, their Krugerrands, whatever they own, I guess, and they can use them in that way, right? And then they get those metals, they get those coins back at the end of the term, usually a 1-year lease term, as I understand it.
That's correct. So you can fund an account with either cash or gold. Maybe you have coins at home, you can send those in, or maybe you want to keep some metal at home, and that actually makes a lot of sense. Maybe you want to take some dollars and buy new gold and have that be what is leased out. So instead of having a savings account in dollars, which isn't earning a high percentage, you can earn 2 to 4.5% in gold in ounces. And this isn't metal that you brought in from home. You can use new cash. So yes, we will take basically all our investors. They will have gold on hand in Delaware or other vaults. We have a number of partner vaults around the world, and we'll send them a presentation. We'll say, hey, Acme Jewelry Company wants to lease 2,000 ounces of gold. Here's their presentation. Here's who they are. This is what the deal is going to be doing. These are the risks involved. This is how we try to mitigate those risks. And if you like it, you can make an offer. And essentially goes to auction. We determine an interest rate by auction. And if your metal gets accepted into the deal, it will go out to that company for the year. And you'll start earning interest, usually monthly or quarterly. And at the end of the year, you'd have the opportunity to roll it over into the next year or take your metal home.
and taking it home could go back to the trust, to the depository. And as I understand it, you won't necessarily get your same Krugerrands or Maple Leafs back. You'll get an account that it's your gold, but it's not the same product as you maybe leased to Monetary Metals to start with.
Yes, you can fund with regular coins, LBMA approved, nationally minted coins, and you can withdraw in those coins as well.
Okay, what I really would like to know to make me feel comfortable about this, Addison, is risk. Can you talk about what the risks might be in an investor sending his, say, 10 Krugerrands or 5 Krugerrands or whatever to Monetary Metals?
Right. And yes, the minimum account with us is 10 ounces. Yeah, that's kind of the key question. How do you know your metal's safe? And, what if it's not safe, there's really not a compelling reason to do this. But that is what our company is all about, is providing a safe way for investors to earn a yield on their gold. We really start out with, to take a step back, we have multiple layers. We look at how the deal is coming together, what the company is, what they are doing with the metal, and the potential risks involved, and then we put multiple layers of controls in place to mitigate those risks. So, the first thing is we vet the company. We want to know who they are, their history, the people, their track record, their financials. We want to know that they're not a risk to go bankrupt. So that's obvious, a big thing that we want to do. The other thing is, in a lease, it's not about necessarily credit risk, though. It's about operational risk, because the metal is present at all times. So really, it comes down to, where's the metal? Is it being taken care of? And so it comes down to inventory controls. We want to look at how they handle their inventory. Do they have a good track record of it? Do they have a good system in place? Do we have visibility into that? And, generally, so then we'll put controls in place, like daily audits. We will be able to check up on their inventory on a regular basis. We get corporate guarantees. We get personal guarantees. One thing we do is we have a UCC file with the courts, and that declares before the courts in the world, this metal that's being leased out belongs to Monetary Metals investors, not the company.
Right.
So bankruptcy as a risk is mitigated that way. And then overall, we have insurance. Like, every lessee has to have insurance for the full amount of the metal. And on top of that, we get Lloyd's of London insurance as well. Mm-hmm. So we put a lot of redundancies in.
Yeah, it seems to me that, Alistair McLeod talked about the time preference. That is, you have, you don't want to holding the metal today is worth more than letting it go. You'd rather own it and you'll let it go, but you'll need to leave it go. You'll leave it out of your possession if you can get a return that satisfies you. So, right. What sort of returns, given what I consider to be very low risk, what kind of returns are investors generally getting on these lease deals?
So our lease deals have ranged from 2 to 4.5% interest. Mm-hmm. And a lot of that depends on the company that is doing the deal. Companies with a stronger track record that are bigger are going to have a lower rate than a company that's just smaller, or maybe a company that's internationally based. Yeah. Again, your metal is never going to go into a deal unless you're okay with the interest rate. You're actually in the driver's seat. So if a deal comes down the pike and you say, okay, well, I want 3.5% on this, and the deal clears at 3%, your metal doesn't go into the deal. Mm-hmm. So you do have total control over that, and so that's one of the real benefits. But yeah, there's different types of deals, and so there's different rates come out of it according to investor preference.
Well, I know that you also are doing different kinds of things. I think you're also possibly getting ready to do a gold-backed bond, or a gold bond, actually. And maybe that's something we can talk about in the future. But for now, Addison, tell our listeners, I guess they can basically go to our website. I know we have a people can go to our website and click on the banner there, and they can learn more. I mean, there's lots of details we just simply don't have the time to get into here today. And every deal is somewhat different, so every deal will have different details. So people can contact you, can they? Can they do so by going through through our website at J. Taylor Media? They click on the gold monetary metals banner. Is that the way to do it?
Yeah, that would be a great way. I think there's an ad on the top left, and you could also email me at addison@monetary-metals.com, and I'd be happy to answer any questions.
All right. Well, it's really an interesting thing, and I think at a time when fiat money is giving you negative yields, I mean, for goodness sakes, or even if you get 1 or 2%, you're getting 1 or 2% in a fiat currency that is losing value over long periods of time. Gold retains its value, it retains its purchasing power, and you only have to look at the dollar. It's lost 93% or so of its value since the Federal Reserve was created in 1913. And of course, more recently, we've seen gold rise, and in my lifetime, from $35 to $1,900, now around $1,500. So clearly, longer term, gold is its value. It holds its value. So, and if you can get a yield, a safe yield on top of that, I think so much the better. Addison, I want to thank you very much for being with us, and we'll talk again sometime in the future. I think you have deals coming up from time to time, right? So people should check out your story.
Yes, we do a number of deals each year. So
excellent. All right. Well, thank you very much for being with us.